Hey everybody, welcome to chapter 19, stock market. Actually, it's the securities market, which is stocks and bonds and a lot of other financial instruments. So we're going to dive into this, just kind of peek behind the curtain a little bit. This is a really big topic and there's a lot more that you can explore in your textbook. There's a couple of questions on your discussion board too. The first three questions are related to the accounting chapter, chapter 17. And then the other two questions are related to this chapter, chapter 19, which is securities markets. All right, so let's dive in. So when we think of security markets, most people think of stocks, and companies want to go public and sell their stock, and everybody who owns shares in that company gets wealthy. And the securities market has a lot of different instruments. Stocks are the most common. And being a public company and doing an initial public offering where you sell shares of your stock isn't for every type of company. So a lot of companies these days, actually, American companies, are leaving the stock market. There's a good article in Fortune magazine that talks about companies going private because they're tired of all the reporting guidelines and the loss of control of their company to shareholders, and the inability to make good long-term decisions for the company because shareholders want increased value right now. But let's look at stock first of all. Stock is ownership in the company. You as an investor buy shares of stock and with the hopes that it's going to appreciate in value and you can maybe sell that stock down the road and double in price. Companies don't have to issue dividends. It's optional. But stock is ownership in the company. And what I want you to know from a discussion board standpoint is kind of the advantages and disadvantages of issuing stock, and also the same for issuing bonds. So when a company first sells stock, we call that the primary market. It's the initial public offering, also called an IPO. And that's when the company makes their money. So if a company decides to give up, say, 30% of their company that they're going to sell as shares of stock, and maybe it's 1 million shares, and the founders of the company are going to collectively own the other 70% of the company. It's a way of kind of taking the company into a big piece of pie and cutting up in all these slices and decide how much do we keep as far as ownership of the company and how much do we sell off to the public. And when they do that, and they work with an investment bank to do that, and they issue that stock out and they make it public, they don't wait for everybody to kind of buy shares that first day. It's all predetermined. It's already sold through an investment bank and the price is already set. That's the primary market, and that's when the company gets that big chunk of money by giving away some ownership of their company. Now after that, anytime that stock is sold again, the company doesn't make any of that money. They already made their money on the IPO. So it's kind of like a home builder builds a home, a brand new home, and you buy it. The money goes to them, the company. But thereafter, you own that house, and maybe you move 5 years down the road and you sell it to John Smith, somebody else who buys that house, and that transaction is between the two of you. The company doesn't see any of that money. That's the secondary market, where individual people are buying and selling shares. So it does beg the question, why do companies care about the stock price so much? If they've already did their IPO several years back, why are they still concerned about the stock price? Well, obviously stock price kind of reflects the health of the company and if they're growing, and it helps them attract better employees who are interested in getting stock options. But most importantly, as you see on my second bullet point, is the company founders and the executives and CEOs and CFOs, they all get stock options as part of their compensation, and they're interested in increasing the stock price because that's going to increase their wallets, right? So when the company stock price goes up, those employees and people who own the business, they benefit as well as the stock price goes up. So it's not just to the shareholders' benefit. Stocks come with some advantages and some disadvantages. The main disadvantage of issuing stock is like if you have a big house and you rent out a bunch of rooms. Now you have all these people living in your house, eating in the kitchen, taking stuff out of the fridge, making decisions about the house and lights and all that kind of stuff. You've got people in your business when you sell stock. other owners in the company. So you kind of lose control of your company. And the classic example, Steve Jobs, the founder of Apple, He founded it with Steve Wozniak, and he didn't have a majority share of the company. You know, he'd sold some of his shares, and there was a board of directors that made all the decisions, and they decided they didn't want Steve Jobs around anymore, and so they booted him out of the company that he founded. Now, he still had a bunch of shares and was still making money off of Apple. He just wasn't a part of the company anymore. He later went on to buy it back. But yeah, there's a real risk of a loss of control of the company and having to keep those stockholders happy. But you do get a big wad of money, and there's no debt tied to it at all. Once you do your IPO and you get the money, those shareholders have the stock. You don't owe them any money. You don't have to pay them dividends. There's no debt. The other option is bonds. Bonds are debt. That's where you're issuing an IOU. You give me some money, and I'll sell you this bond instrument, which is an IOU. And in exchange for that, I agree to pay you back at a certain time frame. So we call that the maturity date. It can be 5, 10, 20, 30 years, and there's an interest rate, which is also called a coupon rate. So it's debt. And that is also sold as a financial instrument. So companies can't go out and find people one by one to borrow money from. They sell bonds, an actual instrument, and then it's available for thousands of people to buy those bonds. Very common for the federal, state, and local governments to issue bonds when they need to build schools or repair roads. They'll issue bonds. I'm going to skip this on investing in stock, but there's Morningstar.com, which is part of your discussion board. That video, you'll see Morningstar is a investment website, and some of you may be familiar with buying stocks online. And some of the ways that they look at measuring stocks and buying stocks. But you don't need to know too much about this slide. You do need to know a little bit about mutual funds. Mutual funds are, it started out when initially there were these little investor clubs, and these little ladies and other folks would pool their money and buy some shares of stock. And then some of them got bigger and organized, and some of them started making money, and they got bigger and bigger and had more money to play with. And they were making good decisions, and they were all, deciding where to put the money and what companies to buy and what companies to sell. And that kind of gave birth to this mutual fund industry, which is basically pooling investors' money. And there's a fund manager who manages that fund, F-U-N-D, not fun, like having a good time. Fund manager who manages all the resources of those funds. So if you have a retirement account at work, a 401k, or a pension, or some type of insurance thing, you're probably in a mutual fund. And there are thousands of mutual funds. And the growth of the mutual funds has been one of the reasons why stock prices have gone up so much, because there's more and more money flooding the stock market as more and more people are investing and putting their retirement into mutual funds. Then someone's got to put the money somewhere, right? Stock prices are supply and demand driven, just like the housing market. If there's a lot of people selling houses and not many people buying, and you got to move, you're going to start dropping that house price so you can unload your house. Prices will go down, right, when there's more supply than there is demand. When more people are trying to buy houses and there's not many houses available, housing prices go up. It's the same with the stock market. So there has to be a buyer and a seller, and the more people that want to buy Apple company stock, or Alphabet, which used to be called Google, the more people want to buy that, there's more demand. There's got to be a seller on the other end who's like, okay, I'll sell it at this price. Supply and demand drives stock prices. It's not just the actual financial performance of the company. In some respects, it's completely unrelated to the financial performance of the company. And there's other issues such as, the positive news that they put out there and how exciting the stock seems to be as far as potential future growth. So you can look at mutual funds as well. That's also in your book. There's your key terms out of Chapter 19. So you can also run through the Chapter 19 PowerPoint, but mostly what you need out of this chapter is the advantages of stocks versus bonds and an understanding of what mutual funds are. Thank you.